Half a year ago, we warned that it both looked and felt like a recession was waiting to happen, even as the central banks were battling elevated inflation. Fast forward 6 months, and these are our key observations. First, a synchronized downturn did not materialize for the major economies. However, new headwinds actually emerged, namely the US regional bank crisis, which saw the failure of Silicon Valley Bank amongst others. There was also market angst over the US debt ceiling, which was eventually resolved. China's reopening pace has also disappointed of late, and still, unexpectedly hawkish rate hikes by major central banks such as the Reserve Bank of Australia, Bank of Canada, Bank of England, have also shaken market complacency about a premature pivot. The outlier is the Bank of Japan, who remains clearly dovish and is only set to reassess its quarterly forecast, especially for inflation. Second, a US recession is still likely over the next 12 months, partly due to the rising risk of a policy mistake where the central bank over-tightens and thus precipitates the next downturn, when credit condition tightening is already ongoing. Unlike the previous cycle, China is unlikely to come to the rescue of the global economy this time. Marginal rate cuts and also calibrated policy stimulus so far suggest that it is still unlikely to shift the dial on growth in the near term. So the risk is also for China's growth to moderate from around 5.7% this year to around 5% next year. Meanwhile, Eurozone is also primed for a deeper downturn as the German economy is already in a technical recession in the first quarter. ASEAN economies are still enjoying a tailwind from the improved tourism numbers, especially from China's reopening. Domestic consumption is supported by a healthy job market, even though manufacturing and electronics is undergoing a slump. As such, ASEAN economies should also see overall growth momentum ease in the second half of 2023. Third, geopolitical uncertainties remain a mainstay in the broader landscape. The Russian-Ukraine war continues to drag on. US-China noise levels wax and wane, but at least dialogue between high-level officials have resumed amidst talk of a de-risking, not decoupling strategy. The everywhere plus one of French shoring strategy implies that ASEAN is still likely to remain a key beneficiary of investment diversification. At the same time, setting up redundancies at the firm and industry level is likely to elevate costs in the medium term. Overall, risk appetite has been constructive but choppy in the last 6 months. The good news is that hopefully the worst is behind us. Financial markets had troughed around October 2022. Market positioning is cleaner, and much of the pandemic-induced supply chain disruptions have normalized. The bad news is that global demand conditions have softened significantly, and the global semiconductor industry recovery has been pushed out further. Last but not least, the US regional banking crisis may still have legs to run in the form of more restrictive credit conditions, stepped-up regulatory scrutiny, and also correlated exposures in the commercial real estate sector. What this means is that investors have to be nimble, seek shelter during periods of heightened market volatility, but also watch for the opportunity to take on more duration risk going into 2024 when the US recession hits and the Fed starts to cut rates.